Hello everyone. Today I will be talking about investing in CDs, also known as certificates of deposit in the United States. CDs are considered one of the safest ways to save and grow money because they offer fixed interest rates and predictable returns. In this presentation, I will explain what CDs are, their benefits, some of the risk, different types, and examples of how people can move forward with confidence when investing in them. What is a CD? A certificate of deposit or CD is a savings product offered by banks and credit unions. When you open a CD, you agree to leave your money in the account for a specific amount of time, technically lock the money for a specific amount of time called a term. In return, the bank pays you interest at a fixed rate. The longer the term, the higher the interest may be. Common CD terms range from a few months to several years. So now we're gonna be talking about some of the main benefits of CDs. So the first one is safety, safe investment. So as you know, one of the biggest advantages of CDs is safety. Most CDs from banks are insured by the Federal Deposit Insurance Corporation, also known as the FDIC, for up to $250,000 per depositor per bank. So credit union usually, credit unions CDs are usually insured by the National Credit Union Administration, known as an NCUA. So this means that your money is protected if the bank or credit union fails. So the second benefit of CDs is the fixed interest rates. So this is another benefit, yeah. Unlike some investments that change with the market, CDs usually keep the same rate during the entire term. And for example, if you lock your money to a CD of 5% for 12 months, you continue earning that rate even if market later if the market rate later decreases. So this fixed interest helps you to protect your money if the market interest goes down. So that's a great benefit. So the third one is a predictable growth. CDs also provide predictable growth. You know exactly how much money you deposited, how much interest you will earn, and when the CD will mature. You kind of got the choice, or the different choices, whatever you want, your desired goals are. For example, in my case, I usually renew the CDs based on the interest in the market. If the interest is high, so I usually renew it, and if I need the money, like, I withdraw the money at the maturity date. That's the difference, and that really helps you, because I usually use the I know exactly how much money I'm gonna be earning for that specific amount of time. And also this makes the CDs useful for future goals, such as for emergency saving, just in case you need money, like in 3 months, in 7 months after they mature, or if you need the money for vacations, tuition, or buying a home. So this is a great benefit, and yeah, that really helps, because I usually use the short-term one. So this is based on my experience in this part. I prefer the short-term. And now we're gonna jump to the important risk and limitations. Um, so the first one is limited access to your money, which means that this is one of the disadvantages because it limits access to your money. If you withdraw your money before the maturity date, the bank may change an early withdrawal penalty. These penalties can reduce part of your interest earned. So, for example, the common penalties are for 3 months of interest, 6 months of interest, sometimes for more for long-term CDs. And the next one is the inflation risk. This is another limitation. If the inflation becomes higher than the CD interest rate, your money may lose purchasing power over time. So this means that, for example, if your CD earns 3% interest, but the inflation is 4%, your money grows more slowly than the cost of living. So this is technically your real buying power decreases, which means that you won't be able to buy more things in the market. So that's your power, your purchasing power. And now we're gonna take a look at the common CD terms. So if you take a look here, there are different, the most common ones. So the first one is the 5 years. This is the longest, the long-term guarantee rate. The 3 years, this is considered a medium-term growth, and the 1 year is a flexible savings goals, and that 3 to 6 months is a short-term savings. So I'm at this level. Actually, like I'm at these two levels because I usually have like saving goals and stuff like that. So I don't really invest like I don't go over a year because I know that in case of an emergency I can withdraw the money, or I can add more money, or make some other financial decisions over the short-term CDs. And this is very helpful to me. So now we're gonna talk about the traditional different types of CDs. So the types of CDs are, for example, the traditional CD is the most common type. It has a fixed rate and a fixed term. And the high yield CD usually offers high interest rates, especially through online banking, online banks. And the no penalty CD allow people to withdraw money early without paying a penalty, although the interest rate may be lower. So no penalty, but your CD is gonna be making a lower interest rate. And there's a jumbo CD, which is one of, I would say, it's for guys or for people who want to invest a large amount of money. So this requires a larger deposits, often $100,000 or more, and sometimes offer better rates. So that is a good one. And the last one, we got the IRA CD, which is usually held inside a retirement account. Now let's go to the CD ladder strategy. So this is one of the popular, actually, like one of the popular strategy is called CD ladder. Instead of putting all your money into a CD, you divide it into several CDs with different maturity dates. For example, you can pull one CD for 1 year, another CD which is $1,000 for in a 2 year. You can pull another CD of $1,000 for 3 year, a 3 year CD, and you can put another one, another $1,000 for into a 4 year CD. So this strategy helps provide flexibility and allows you to take advantage of changing interest rates over time. This is a great benefit, because it gives you access to your money at different times. It reduces the risk of locking all funds at one rate, and it helps take advantage of changing interest rates. This is technically what I do, guys. Um, as I mentioned, I invest in different cities. Actually, like at this point, I want to mention that I prefer to have 3 to 4 cities, the different maturity date, and usually less than a year, because I have saving goals and stuff like that to buy a house. So and that helps a lot. And since um, my son goes to college, so I don't want to lack a large amount of money in one city. So as this city ladder strategy mentions, we really want to take advantage of the different changing interest rates. For example, you can have, for example, if you have the 1 year one for a 4% interest rate, and let's say that for the 2 year CD you have, probably if the market is doing well, you can get like a 5% there. And then for the 3 year one, let's say that you are getting a 7%. So it means that you're taking advantage of the market, but at the same time, if the interest rate in the market is really low, so you have the choice to either keep investing or withdraw the money and close the CD and wait until there's a better opportunity. When the interest rate is high, that's when you lock the CD again. So this is one of the strategies I use, and it's very, very helpful. Now, um, things there are different things that we need to compare before opening a CD. So they do have higher return opportunities. This is technically like a popular strategy, as the one I mentioned before, the CD ladder. uh, so this is technically the same information as the last one. So but here are the things that we need to take a look, guys. For example, taxes and city earnings. This is one of the biggest ones, because interest earned from cities is taxable income in the U.S. banks. Usually, for example, I get the 1099 interest form for earned interest, which means that every time I report I do my taxes every year, I have to report the interest I earned on the CDs for the whole past year. For example, for the 1099 interest form, I use that one to report my interest earned from the year of 2025, when I did my taxes like a month ago. So this cool, there are other benefits that the CDs may be a good choice. For example, if you want low risk, that's me. I prefer low risk. I don't want to take like a high risk to put a lot of money at the variable interest rates or something like that. And CDs are really good at that. Like, they give you low risk. And they they actually give you guaranteed returns, because if you lock the money for 3 months for a 3%, you know that you're gonna be getting a fixed interest rate of 3% interest rate on your CD and your money. And also also they are very helpful for saving. As I mentioned, like I have like saving goals, so that helps me a lot, and that might be one of the things that you should consider if you are saving up for a car, for a house, for your college or something like that. And actually, like, I'm not that ready to invest in the stock market yet, so that's why I do prefer the CD. And this if you are just like me, that you don't want to take like the risk of investing in the stock market volatility, so this might be a good choice for you. And now, when CDs may not be ideal. The CDs may not be ideal if you need quick access to cash, because remember, you need to lock the money for a certain amount of time, which can be 3 months, 4 months, 7 months, 11 months, or a year, 5 years, 2 years. So you technically lock that money for that amount of time. And there's, if you withdraw the money, remember that we were talking about the penalties that they can charge you if you withdraw the money before the maturity date. And the other thing is that it might not be ideal if the inflation is so high. For example, if the inflation is like 10%, and then I'm getting an interest rate of 5% on my CD. So that might not be good for me, because I'm losing the purchasing power, right? So I won't have enough money to buy my, the basic needs, right? So the other one will be that it might not be ideal if you want a higher long-term growth. So, for example, if you have money that you really want to invest to get a long-term growth, that this is not a good choice, because uh, they are usually like, they don't earn a lot. And another thing that the cities may not be ideal for you is if you are comfortable with high risk investments like stocks or mutual funds. So, for example, if you are already investing in stocks or mutual funds, so cities might not be like a good choice for you, because actually, like, you can earn more money at the stocks and by investing in stocks in mutual funds, right? So that's it for this part. And now, moving forward with confidence. Now, after for the example one, starting small with confidence. After researching interest rates and learning about FDIC insurance, Anna confidently opened her first 12-month CD with $1,000 to safely begin growing her savings. So that means that after she learned that the money is like it's backed up by the FDI insurance, up to $250,000. Remember that we were talking about that. Just in case if the bank fails, you actually have that insurance covering like the first $250,000. So the next one is we're gonna be talking about the using a CD ladder strategy. So this means that to balance access to his To balance access to her money and earn steady returns, Carlos moved forward with confidence by creating a CD ladder with different maturity dates. This is a really good one, guys. This is the one that I'm using, but in a short-term CD, less than a year. So, for example, I have one for 3 months. I have another CD for that matures in 4 months. I have another one that is for 7 months. So I have different ones, and I don't put like my all my money in one CD. And the next one is planning for a future goal. Knowing she wanted Knowing she wanted to save for a home down payment in 3 years, Elena invested in a long-term CD because she felt confident about the guaranteed interest rate and predictable growth. This is like a good one. So if you feel like you are really confident in investing in a long-term CD, go ahead and find more information at the traditional banks that I know. For example, Wells Fargo, if you go to their website, you can look for CDs, and it can tell you exactly what are the terms that they have and what's the limit amount that you can invest in order to start getting those interest rates. And it actually gives you more information, and that's with all the, like in West Fargo, Chase, Bank of America. I know that they have the CDs, the short-term CDs too. But yeah, so take a look at the different banks or different investment banks, so you can compare the interest rates, and you can go from there. So in conclusion, certificates of deposit can be a smart option for people who want low risk investments and guaranteed returns, just like myself. CDs provide safety, fixed interest rates, and predictable growth, making them useful for many financial goals, I would say. However, it is important to compare interest rates, understand penalties, and choose the right CD strategy based on personal financial needs. Thank you for listening. See you next time.